Hey folks, David McKnight here, best-selling author of The Power of Zero, and today we're diving into a hot take that's been making the rounds online. Take a listen to what Dave Ramsey's sidekick, George Kamel, recently said about cash value life insurance.
Here's why life insurance as an investment is really a scam. If you borrow any of your cash value and then die before paying it back, the insurance company takes it out of the death benefit that your family gets. College for your daughter? Oh, never mind. And what about those investments the insurance company has been making for you? Well, the returns are so small, you would need a microscope to see them, especially after the company takes its share in fees. But don't worry, it gets worse. Most of the time, if you die without using your cash value, the insurance company gets it. That's right. The insurance company gets to live it up on your savings while your family only gets the face value of the life insurance policy. Not cool. Not hot. That's not even mid for you Zoomers out there.
Now that's a loaded statement, and like a lot of financial guru advice, it's dramatic, but is it accurate? Let's unpack it. All right, let's tackle this first point. With life insurance policies like Index Universal Life, does the insurance company really keep your cash value when you die? No, that's not really at all what's happening. The way most of these policies are structured, as your cash value grows, the amount of life insurance you're required to pay for actually goes down. So for example, when you start the policy out, if you have zero cash value and a death benefit of $500,000, you're paying for $500,000 worth of life insurance. If you were to die that first day, your heirs would receive zero cash value in the full $500,000 of life insurance you were paying for. However, if your cash value grows to $400,000, then you're only paying for $100,000 of life insurance, but your total death benefit is still $500,000. So if you were to die, your heirs would receive the $400,000 of cash value and the $100,000 of life insurance you were paying for at the time of your death. This is a far cry from what George wants you to believe. If you take what he's saying at face value, it sounds like those nefarious life insurance companies are simply absorbing your cash value into their coffers, preying upon those who have passed on when they could no longer do anything about it. Next, George frames cash value life insurance policies like Index Universal Life as an investment alternative. In reality, IUL only really works when used alongside traditional stock market investments, not in place of them. This idea that it's either or, either you invest in the market or you use life insurance, is a false dichotomy. The real power of IUL comes when it's part of a broader tax-free retirement strategy that includes stock market investments in Roth IRAs and Roth 401ks. Let's talk about where the IUL truly shines and where most financial gurus completely miss the point.
Are you serious?
It's a risk mitigation concept known as the volatility shield. Here's how it works. Let's say you retired and the stock market has a down year. Think 2008 or 2022. If your entire income is coming from your stock portfolio and you keep withdrawing during that down year, you risk locking in those losses permanently. It's called sequence of return risk. And it could send your portfolio into a death spiral from which it never recovers. That's why experts say you should never take more than 4% out of your stock portfolio in any given year, especially in the year following a down year in the market. But if you built up 3 to 5 years of living expenses in your IUL, you don't have to touch your portfolio that year. Instead, you draw income from your IUL's cash value, which didn't lose a dime in the market because it's protected by a 0% floor. This gives your stock portfolio a chance to recover before you take further distributions. The result? You can increase your sustainable withdrawal rate from 4% to as high as 8% per year with a 95% success rate. That's not a scam. That's a strategic use of a financial tool that dramatically increases the likelihood that your money will last as long as you do. In fact, a recent study by accounting powerhouse Ernst Young said that the combination of IUL and stock market investing yields far greater income to the retiree than stock market investing alone. The numbers couldn't have been more eye-opening. Next, George claimed that the returns are so small you'd need a microscope to see them. Let's test that. A properly structured IUL can yield net returns of 5 to 7% over time with no downside market risk. That's not designed to compete with your high-growth stock portfolio. It's designed to replace bonds in your portfolio. Ask yourself this: would you rather earn 3 to 4% in a bond with full interest rate and inflation risk, or 5 to 7% in an IUL with zero market downside? That's the real comparison. This is why Tom Hegna and other retirement experts for years have said if you reach into your portfolio, remove the bonds and replace them with cash value life insurance, you increase your return, lower your risk, lower the standard deviation of your entire portfolio, and experience a better outcome over time. Now, let me be clear. IUL is not a silver bullet. It's not a one-size-fits-all solution. It's not a panacea. But when used in concert with your stock portfolio, that's where the magic happens. This combination creates a more resilient retirement plan. And let's not forget, IUL loans are tax-free. You can take income from your policy with zero taxation, which increases the likelihood that you'll be at or near the 0% tax bracket in retirement. And we love the 0% tax bracket because if tax rates double, like many experts are now predicting, 2 times 0 is still 0. Another claim George makes is that the insurance company takes their share in fees. Now, do IULs have high fees? If you fixate exclusively on the early years of the policy, you might be inclined to say yes, but those fees drop dramatically over time, and when averaged out over the life of the policy, they can end up costing you less than 0.5% of your cash value per year. That's as low as some of the most inexpensive 401k plans in the marketplace. So here's the verdict. George Kamel's statement is emotionally compelling, but it's misleading and ignores the strategic use cases of IUL when properly structured and paired with other investments. Here's what he should have said. Index Universal Life is not a scam, but it's often misunderstood, oversold, and misused. It's not a replacement for stock investing, it's a complement. And when used correctly, it can enhance your retirement, mitigate risk, and provide tax-free income at a period in your life when tax rates may be dramatically higher than they are today. That's a much more balanced and accurate take. So, if you've been led to believe that IUL is a scam or that you should only buy term and invest the rest, I'd encourage you to take the more nuanced view. Financial planning isn't black and white, it's gray. And that gray area is where the smart money lives. If you'd like to learn more about how to use IUL in concert with your stock investments as part of a balanced, comprehensive, tax-free retirement strategy, head on over to davemcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in my network that's been trained, vetted, and qualified personally by me. And don't forget to like, subscribe, and hit the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.